What's up, everybody? Welcome to the Operators Podcast. This is the first crossover ep. We have a spinoff in finance operators. We have a spinoff in marketing operators, and we're combining forces, okay? We are Thanos, bringing together the Infinity Stones of operators to have the best episode we've ever recorded. It's about exits. I hope you enjoy it. If you learn something, check out their shows. If you want more, we're here once a week, sometimes twice a week, here to help you be a better operator. Thanks for listening. Thank you, Northbeam. Thank you, Richpanel. Thank you, Saras Analytics. Thank you, Postscript. And above all else, thank you, Fulfill, the #1 sponsor on earth. Thank you, guys. Talk to you later. Bye. New Fulfill ad alert, everybody. We have a LinkedIn post they wanted me to read and review. So I'm going to be reading this post and giving my commentary. It's a new dimension of ads. This is like 3D ad building. So shout out to Phil, come up with this concept. Jeremy says, configuring NetSuite to Shopify was a bottom 3 project for my career. It's the definition of boomer SaaS. Yep. That's everything I've heard is that NetSuite's way too expensive and doesn't really work. What started as a 6-month project didn't get launched for 18 months. Took dev teams, 3PLs. I don't know what a SL is, but yeah, I've just heard horrible things that like you get sold this like beautiful, shiny package and it ends up being hell. Like you're signing up for like, worse than a root canal. Getting inventory to sync properly with 3PL to Shopify. It's the one reason he doesn't have hair anymore. Hilarious. Adding EDI was painful. Yeah, dude, e-commerce is built on all of these horrible softwares that just that you hope work together. EDI for legacy retailers. You have like a order management system. You have a WMS. You have all that type of stuff. Fulfill just does all that for us. So it's one bill I have to pay. They connect to my 3PL. They make sure all that stuff works and the data just flows. So at the end of the day, we had all the data. In NetSuite, accounting was easier. I had mostly correct inventory access, but there was times where it broke and then they got oversold. And then he had to manually override the inventory. That's just a very old school legacy system. It's kind of like building your website on Demandware or whatever legacy system was before Shopify. So yeah, that's the old school way to do it. There's new ways to do it. And the new ways are Fulfill. But yeah, man, look, it's modern software for the modern era, right? NetSuite was a legacy standard in 1999. And I was 5 years old. Don't you think you should have software that's built at least in the past 10 years? That's what Fulfill is. So I use it. Jason uses it. If it's good enough for Jason, it's good enough for me. If it's good enough for me, hopefully it's good enough for you. Appreciate Fulfill being here the whole time. Flagship sponsor for a reason. I literally give them $100,000 a year. So it is what it is. I love them. They're the best ERP that money can buy, because they're better than NetSuite. Thank you, everybody, for being here. Thank you for listening. Let's start the show. Well, dude, this is the first 3-way crossover, the first 3-way pod ever recorded. So we got operators, marketing operators, finance operators. Pretty soon we're gonna open up pizza store operators. We're just trying to get the full gambit going.
I would actually listen to that show. I'd love to know more about pizza.
I think it's a good idea.
Franchise operators. We're selling rights to the show. So if you have a local country and you want to be like the Albanian operators, dude, we'll sell you the rights.
I didn't know this, but sure.
It would work.
All right, we're talking. I think so. We're going to talk exits today, boys. That's the idea. Is
my favorite topic.
M&A, acquisitions, exits. Drew, I feel like this is going to be your show, man. In that you've got to kind of school us here. And maybe, Sean, this was your idea to talk exits. So like maybe start us off with why this topic? Why now? Just let everybody in on the secret. What's going on?
Well, I'm a loyal listener to Finance Operators. Link in the description if you want to go check out Finance Operators. And their first episode was about beverage acquisitions, right? There's a couple high profile ones. Poppy just got announced for close to $2 billion being bought by Pepsi. It seems like there's a lot of energy and excitement in the beverage space. Traditionally a horrible category, very, very difficult to succeed. So if you can make it, people try to buy you. But that's at like the direct opposite of what's happening in a lot of like durable and the rest of the consumer market. It feels like still very pent up. There isn't a lot of deals transacting. And I'm trying to sell operators franchise rights because damn, it might be a recession, guys, right? Like I've been hearing bloodbaths from brands, right? Someone high up at one of the big tech companies told me that it's a bloodbath right now. So with that being said, there's people who we got into this business to make money, right? And there's always been this promise of an exit somewhere down the line, somewhere in the future. And that feels further away than ever before. So Drew, guide us back to the light.
I don't really agree. I don't think it's far away at all. This is what I'm excited to talk to you guys about this because you're all sort of on the operating side. I sort of went over to the dark side, but I couldn't be more bullish on M&A just for the whole sector. For like beverage is obviously like scorching hot right now, and like the Poppy one was sick, the Alani Nu was sick, like Ghost was a great acquisition. Like I don't know. I think a lot of these, you guys are all bootstrapped too, which is kind of the interesting part of this conversation as well.
Well, I'm not. Right, I'm venture. Yeah,
you are. Okay.
I'm venture.
Okay.
John and Cody are bootstrapped. So we've got like decent cross section here.
Okay, cool. So we can we can do half and half because like my like sense is that these like venture funds that started in like 2012 2014 sort of time frame, like it's been 10 years, and the whole like better for you like food and bev sort of category thing idea like is kind of coming to its like maturity, right? So like like Poppy started in 2015 really, and 10 years later like that's kind of the max for some of these like external capital sort of funded brands, and then like after like 17, 18, like there was only so many like better for you like oatmeal mixes that like these investors could invest in, and so they started to move to the clean beauty or whatever else, and so there's a big wave of those brands that got funded 2017, 18, 19, 20, and like that's going to be the next domino to fall over the next 3-4 years. And so I think of this as like the starting gun for like a lot of these things, and you just like have like these massive profitable scaled assets and like Alani Nu, Poppy, Ghost, and even like Owen, like the protein RTD. It's like it feels to me like they're getting snapped up, right? And like eventually there's not going to be anything left, and then people are going to be looking around and be like, oh shit, like I totally missed the M&A wave. So like I have a question for any of you three, which is like, I'm sure you guys with like running successful brands, like you can probably feel it just by like the amount of like bankers or investors or private equity that like reach out to you. Like, do you feel anything lately? Like, does it feel like volume's picking up or any excitement like that?
So weirdly, it's been super quiet for the last 2 years. And then in the last 2 weeks, we've had, I would say, a couple larger. These are strategic. So like they're not financial buyers, they're not private equity, but like out of nowhere too, kind of came knocking and kicking. And I thought that was a little weird, like timing wise. So I don't know. I Sean and Cody, I'd be curious to hear your thoughts on this. Sean, I know you talk to a lot of bankers. I don't. I tend to avoid as many of them as I can. It's like, I don't have a great track record with bankers. But yeah, it does seem, I don't know if it's just like pent up demand and there just hasn't been much done outside of consumables in the last while. I feel like beauty had a bit of a run a few years ago. Now it's like bev. So I mean, who knows what's next? But yeah, in durables, it still feels like really quiet, really hard, not a lot of demand on the buy side.
Yeah, well, let's talk about beauty because beauty did have an amazing moment. There was a bunch of IPOs, right? So we had the Ilia Beauty, that whole little like mini roll up. You have Olaplex, like all of those were like very probably like late to the bubble IPOs. So Cody, are people trying to knock down the door and get some Jones Road Beauty stock, or what's going on?
Feels like it feels like there's the same amount as always. I've trained my assistant to go through my email and just like anything that doesn't look like it's like, anything that looks like a cold email, she like deletes. So they're probably getting in there. I don't exactly know. There's probably some offers for our business that I don't even know about. Maybe I should go through them. No, but I think, obviously you have, Oddity. They're a little bit more of an AI company than a beauty company. But besides that, they're crushing it. Beauty is definitely a little bit soft. There's rumors of a lot of like the big ones, not big, but like newer startups that are on the market, like Merit's on the market. I think Kosas is on the market. Obviously Glossier has been looking for a while. So there's been a few, but beauty is definitely a little bit struggling and soft. So even though a few years ago it was pretty hot. The last like 2 years, I think it's been people are really holding out, and I think a lot of these brands have been trying for a while, and I could expect some of them to go in the next year or so.
Cody, you called Oddity a AI company. Are you throwing shade or
no? They're actually so impressive. They're like one of the only like newer IPOs that's crushing it. They're growing and they're profitable. So no, whatever they're doing, they're crushing it.
Yeah, because very famously, it's Oddity Tech, right? And there was and it's like, what's the tech angle? And it's like, oh, the quizzes, and yeah. But look, I mean, if they're making good products and they're crushing it, they bought our good friend Evan's brand. So I hope that stock goes to the moon.
He's like a full blown scientist.
He's a real scientist. Yeah.
Yeah.
Drew, I know you want to jump in, but I'll give you guys my take. In September, we had rate cuts for the first time, right? Going into the election. The next day, I kid you not, I'll show you the timestamps. I had 4 bankers in my inbox, right? Being like, people I was friends with in 2021, they're like, hey, I haven't worked in 2 years. There's rate cuts. Can we sell your business? Right? Like that's basically what had happened. And private equity groups start trying to set up meetings. Like all of that happened as soon as there was rate cuts. Ridge isn't in market. So like I meet with them, I hang out with them, but then I kind of, take a beat, go through the election, go through everything that just happened. The conversations are starting again. So probably late February, the email started coming again. I think they thought there'd be more rate cuts, right? Or maybe the stock market wouldn't take as big of a hit. But the shocking thing is that bigger banks seem to be moving into lower market deals. And for all of our listeners, right, what does that mean? It means Chase has like an advising arm, and they're trying to get me to work with them to sell my business. And I'm not big enough for Chase to do my deal, right? Like listening to, finance operators, you guys were making fun of maybe it was the Alani deal or maybe the Versace deal, like UBS did
UBS.
Like, yeah. If that's because UBS like gets caught up in like stealing and scamming, money laundering shit all the time.
That's why it was funny that they published the 12x pro forma fully synergized EBITDA.
Yeah. So like they're just a little more. They're the Wild West Cowboys of bankers. Chase is like really really buttoned up. You expect them to do $100 billion mega mergers, but then they're emailing the wallet company being like, "Can we do your guys' deal?" So I just think it's still in a weird spot. I'm less bullish than Drew is on it, but Drew, you're the finance professional. What's going on in the market?
Well, so like I think what was really critical with the Poppy thing, so like obviously like everybody knows that like Pepsi like went and offered that to Olipop too, and Olipop was like, no, we're not interested. And then Poppy ends up like obviously accepting the deal, and like I was just doing research on sort of like the available information, and like it was reported that they were at like 600 million in sales or so in January, and so like let's just use that number from like a trailing 12-month perspective, like. This was a 3.3x on like a sales multiple for like the gross acquisition price. And like Alani Nu was 2.8x. So like what I think is interesting is the energy category, like energy drinks, is like a $73 billion market. Like probiotic soda is like 5 years old. It's like a $4 billion market. So they're paying like a premium for this Poppy company that's in a smaller market. It's less proven. Like I think it's like you're like that was I don't want to say desperation move by Pepsi, but like clearly they like Poppy had a lot of leverage in this deal. And so I think like you're starting to see some of the leverage like in general shift to these companies that have like good, big, businesses. And like Spindrift is like another good example. And, you saw like, what was the other one? Oh, Simple Mills, right? Like 800 million all cash to Flower Foods. Like these companies that are like, it just feels right. And like as like the more deals that happen and the multiples are going up, it just signals to me in like, less proven markets, it signals to me that people want to buy more, right? Because like apparel is a whole shit show. Like I mean, whatever's going on over there is like, like those companies are getting sold for 0.2x their top line. And it's like, okay, like besides those guys, I think there's like a lot of like pretty good activity, and like the buyers just seem to be paying a lot of cash and, not a ton of like deferred compensation, or even like the Alani Nu, like there wasn't like too much stock in that deal. Like it was a big chunk of cash. And so I think you guys are right. Like beauty with like K18 and Aesop and those a couple of years ago were great. But once a couple of these other ones go, like I don't know what you guys know about like the supplements sort of market right now, but like the Pro Mix deal was like quietly like a really premium nice deal. And then there's a couple other, pretty scaled supplements companies that you're going to hear about in the next couple of months. And so starts out food and beverage, moves over to supplements. So we're still sort of in the consumables world, I guess. But I really do think, only a couple more of these things are going to tip over. And then all of a sudden you're going to start to see the floodgates kind of open.
Does that go like, when you say that, Drew, do you think it then opens up to non-consumables? So like you get into more of the durables companies, and then who are the buyers? Like, is it sort of start with these big strategics, and then ultimately there's like the private equity financial buyers that will come in following them, and like I don't know if anybody wants to take this as well, but like the dynamic that plays out in these markets, right? And Sean, I'm sure you have seen some of this stuff and talking to your bankers. Like,
well, I think I'm gonna jump Drew, and what I'm gonna say is, the public market is the ultimate buyer of all assets. So it's either a strategic or going public, and strategics are usually public, but you don't typically get to go there without going through a couple private equity hands first. So talking about Poppy or whatever, I'm sure they raised $400 million. I mean, you bet you is a real number, but they probably raised 9 figures from VCs to be able to get that exit, right? Like
they raised 40, just for the record, they raised 40 million.
Dude, and that's
not a lot.
Yeah,
no, it's nothing. It was like a 50x, MOIC.
Good for them.
Yeah.
That is not a ton of capital in beverage.
Yeah.
Like beverage is freaking hard, man.
But in general, yes, Sean is correct. Like Olaplex was bought at 100 million in sales. Like Advent International bought the whole thing before they took it public. So Sean, generally speaking, is right. Poppy's just a bad example.
Well, I mean, yeah, like, okay, Poppy's a bad example. They still raise money, right? So me and Cody out here not raising any money. If we want to get one of those big deals, we're probably 2 hand transfers away from getting that done. Right? Like somebody has to buy you, do some shit to you, and then give you to somebody else.
You basically have to sell to a wholesaler being a private equity play, right? So like somebody who's going to buy you for a certain multiple and then flip you. Hence why I call them a wholesaler. But like, that seems to be what you're talking. That's the move.
Yeah. And, talking about these strategics, right? Food is in a really weird spot because you have fucking like GLP-1s coming out. You have RFK, and like the money transfer from food stamps to Coca-Cola and Pepsi is fucking insane. It's like $8 billion a year is spent from US public funds on soda, and they're honestly worried that's going to go away, right? So they have to get into other categories with different types of consumers and different type of multiples. And if you talk about, I think you said Poppy has like 15% of the probiotic soda market. It's like, like when you have 15% of a small market that's growing really fast, I mean, someone's going to want to buy you, right? They're like, oh shit, that's going to be the next Pepsi if probiotic soda ends up being the thing that replaces normal soda. Am I wrong in any of that?
No, I think the only thing I would add to Matt's kind of point, and this is probably worth taking a step back and adding some context, is like when the strategics come to the table and start buying, it just it's like a domino effect of the entire capital stack, right? Because like you said, like the private equity's got to buy you, and like they're only going to buy you if they think they can sell you, right? So once private equity has a little bit of confidence in like selling a company to a strategic, then they step back at the table. Once private equity steps back to the table, well, then the VCs are happy to do it too because they can get exit liquidity from the private equity. And so it's not like that linear in practice, but like generally speaking, like you can think of it like it kind of like comes top down, right? I mean, like once the big money starts to kind of like trickle down almost. Like I think that's kind of the highlight. That's why I get so bullish because like I think it's the thing about the energy market, right? With the Alani Nu was like that was the last one. Like the top 10 energy drinks now are all owned by giant conglomerates, and so now like Red Bull, which has never made an acquisition ever, I guess. But like there's like no real asset for Red Bull to buy, and like they're like it's like the innovator's dilemma. Like at some point they have to do something, right? I mean. How do you guys think about like when in your businesses? Like you're obviously not as big as Red Bull, but like at some point, like would you guys ever like make an acquisition or something? Like you have to like get share somewhere once you stop growing at a certain scale.
Well, let's
I definitely would, but I'd love to hear Cody. Yeah. Like you're in on the beauty side, like that's actually an interesting place to look at it, right? Because I feel like beauty is one of those categories. There's tons of startups all the time.
Yeah, we just had a meeting this morning actually with our finance team. We're working with like a really good fractional firm that's like former investment bankers. So second on that point that Drew said, it's like all downstream of the strategics, and private equity will kind of buy you, and then like grow you and make you more profitable for 5 years. So totally agree with that. They were asking about it. We thought about it. I actually made a play to buy like a ad creative agency. It was like, hey, like this is the biggest focus and need for us. Let's just, instead of building it over 2 years, let's buy it. Didn't work out, but that was focus. No, I mean, I've thought about it. We've considered it. There was like a retailer that was struggling that had like 15 retail locations. I was like, let's hop in there and get in there pretty quick. Like, I think that one would have made a lot of sense for us. I think definitely in terms of having capital and being able to like buy into a certain demographic or market that we want to be in, definitely have, considered it. We just haven't really been that strategic about it, but we haven't raised money. But I one thing I've been coming back to a lot recently, especially as we're trying to like figure out some new growth paths, is like, what would we do if we raised money? We've never raised. We've obviously met with a few folks just to kind of hear them out and stuff. And, to me, it's a really interesting just like thought process, because what we decided is we probably had the capital to do any of those things, and we should probably be doing them anyways.
Well, dude, capital really does like breed restraints, right? Like, I'm looking at the tariff situation. I'm looking at the cash outflows of my business daily. And I'm like, yeah, I think I can get everything done if I cut 5 heads, right? So I'm probably going to fire 5 people. I probably wouldn't do that if I had $20 million in the bank from some, firm, right? Right now, every dollar is my dollar. So I feel and care about them so much.
Yeah, you can't really afford to get over your skis if you're bootstrapped. You got no choice.
Or like, hope stops being a strategy, right? I think if you raise money, you end up being like, oh, well, I have $20 million, so things will probably get better, right? But like, I have to be like, dude, everything's dying all the time. But going back to it, Cody, who would you buy? Is there a brand out there that you're like, oh, it's really complementary to like everything we're doing?
Skincare isn't huge for us. It's obviously a really big category and growing category. And I've even met with like some LVMH people that are like, yeah, we're really only buying skincare at the moment, or like you're really only getting into Sephora, either your road or your skincare, pretty much. So just thinking in terms of category, I don't know if we would. I think, what we were saying earlier is like, let's say we were planning to hold this forever and be a family holding company. Like, that makes a lot of sense, especially with us. Like, we just want to stay D2C. We would be way bigger if we went wholesale. We just have no interest in doing that. And so we'll, at a certain point, we've grown pretty quickly. We'll get to a point where we're like, I don't know how much more we're going to grow at D2C. Let's maybe not grow this brand and let's maybe grow a little bit more horizontally. But, don't know if that's in the cards for us.
Sean, you and I have been chatting, and I guess, Drew, this is sort of your question. Like, I don't know if I would be a buyer of brands, maybe, like if the right kind of product, right category came along. But I'm definitely interested in building more. Like I think I'm like, overall, I'm bullish on consumer goods. Like, we've talked about this in the show before. I just think like where things are going on the tech and SaaS and AI, all that stuff, I kind of like physical things right now. And I always tend to be like an underdog guy historically too. So like, consumer just feels so bludgeoned and beat up at this point.
So bad.
That like it's only up from here. Like, I think we've just all been swimming in shit in the gutter for so long now that I'm like, there's sunshine. Like I can see it. There's like, glimmers of sun rays coming from the sky.
No, dude, that's just more piss. Drew. What's up, guys? Sean from Ridge here. I'm here to talk about the value at MTA Solution can provide to brands. So we've been on Northbeam since day one. We were the first customer. We were there when they were building the platform, and they built it for the needs of a high growth meta dependent brand. Okay. That's what Ridge was back then in 2017. It's what Ridge is now. And they've been building a tool for meta dependent brands the entire time. So what are they trying to solve? What is the problem here? Well, first party data is more and more critical. End-to-end first-party analytics and multi-touch attribution is the only way to guarantee the right spend allocation. Now, ad platforms max out at 30 days of attribution. Now, that works for some brands, but most brands it doesn't. The power to understand a customer journey, no matter how long it started, has a huge impact, especially for higher AOV products. As we get into luggage, as we get into rings, we just need to understand what's making these customers come and make a purchase with us. Using a tool like Northbeam and MTA tool diminishes the overcrediting of things like retargeting and branded search. We all want to know where that customer actually learned about us and where it started. So here's just some data from Northbeam. Northbeam customers do better, period. They've measured over $3.8 billion in spend and $26 billion in revenue. Okay. Now, they measure brands pre and post launch, and post launching on Northbeam, they see a 5.5% revenue improvement. They see 7% increase in new customer transactions. They see a 3.5% increase in media efficiency ratio, MER, and they see a 5% decrease in customer acquisition costs. So this is the data from $4 billion in spend, $26 billion in revenue. Revenue's going up. MER is going up, new customers are going up, CACs are going down. You're acquiring more customers, doing more revenue, more efficiently, post using Northbeam. So that's data in aggregate. Take it for what it's worth, but we've been using Northbeam the entire time, and I'm about to have my best year ever. Directionally, thank you, Northbeam, for everything you do. Appreciate you. Thank you for sponsoring the podcast. If you want to spend more money and do it more efficiently, hit up Northbeam. Tell them I sent you. Thank you so much. Drew, so this episode's about exits, right? So we had like the experts come in, you and Cody.
I thought we were talking about meta ads. Actually, I should have realized what the topic was until I should have known before I showed up.
We genuinely said we're not talking about.
You know what's funny though about that? So Matt said let's not talk about meta, and then Matt and I texted for about an hour this morning about meta ads.
About fucking meta ads. I know. This is like
you can't get away.
No,
that's what really matters. Yeah.
So we just spent, this is so unstructured, 20 minutes talking about like these really big, awesome IPOs, right? Those are exits, right? But all of those brands being bought are doing, the smallest brand on that list is $300 million a year in revenue, right? And has a cap table that has a professional on there. It's either a PE group, a family office, a VC, or whatever else. Now those are like those are the trophy exits. Like if you do those deals, you get like a little desk toy being like, "Hey, I sold this thing, really awesome," right? Those are not the listeners of this. And if you are the Poppy CEO and you listen to the Operators podcast, what the fuck are you doing with your life, right? Our listeners are doing, 1 million, 5 million, 10 million, 30, 50, maybe 100, right? That's who we're hitting. Those people are the people getting pissed on for the like tariffs and trade wars and everything else going on. So what is that like very small end of the market, the mid market? Like, are there bites? It's just too early to tell.
There is. And so I can't say yet, but we are on the finance operators. We're going to do like a bonus exclusive with this founder that just sold his business for in between 10 and 20 million, I'll say. And it was like all cash at close, like, multiple on revenue type deal from a strategic. And it doesn't sound like that cool. And I don't know that Maytab wanted to do it as much as I did it, but I was like, this is a really important deal because people need to know about this because it gives you like a little bit of hope, right? Things are, this is, I get riled up on this too, but it's like, if that brand can do it, like there are lots of brands that can actually do it. And like a lot of times, they just give up because they're like, I'm flat and I'm, not profitable or whatever. But like, and for the last 2 years, like, yeah, fold up shop, dude, like go get a job kind of a thing. But like, I think this is a really, really interesting data point and like they raised like a good amount of money too. Like they almost raised like $10 million. So, it's not like the founder, took it all, but he did great. And so like, I think Sean, there is bites at the sort of micro market level. And like, the more that we hear about that, the more people will see the light at the end of the tunnel. And like, there may be like a little bit of piss, coming along with that light. But like, I'm excited to talk to this guy. We're gonna air it as like a bonus episode for off cycle or whatever, because I had to fight for it. But it's cool. It's exciting,
dude. Well, bonus episodes, I'd love to hear that. So Cody, you guys got a bonus episode coming out or just sticking to the schedule?
No, I didn't know we do that. Can we get extra sponsors in them?
Yeah.
They're free.
Speaking of our sponsors, Fulfill, Postscript, Saras, Richpanel. Northbeam. There you go. Love all you guys. We have so many sponsors. We're also sponsored by Gray Block Pizza, just local pizza places. Okay, so this guy got $10 to $20 million, but he raised money. So was there not a preference stack? Like, did he end up getting multiple millions of dollars?
No, there
in his
was,
pocket?
but it was. I don't want to go too into it. But it wasn't like a predatory pref stack or anything. Like he ended up doing just fine. There's like a little bit of debt on the business, I think, and so, they're gonna do like a PR. Well, actually, when is this episode coming out?
I don't know.
I should probably just shut up right now, honestly.
yeah.
Probably
a few weeks.
Yeah.
Oh, okay. Well, then maybe actually it'll already have happened. But anyways, they're doing a PR push in 2 weeks, and so you'll hear about it, and you'll recognize the brand, I think.
So, Sean or Drew, because I guess you guys probably like the most active in this space. I'm not talking to a lot of people, but is there in this like smaller, call it like $10 million to $100 million deal range, is there beyond just activity? Let's just put that aside for now. If you're an operator, you're a founder right now, right? And you've got one of these companies. How should they be thinking of timing in all this? Like, is this a 12-month cycle, a 5-year cycle? Like, are we at the beginning of something longer term, based on what you've seen in the past? Maybe Drew, let's go with you, but like, you've looked at a lot of deals, right? And you're seeing some activity. Like, if we're at the beginning of it, what's the window that people are kind of staring at here?
Oh, man, it's such like a kind of macro question to like Sean's earlier point too, right? Like, I think the only thing that's like kind of spooking people right now, so like when that rate cut came, the like 3Q last year, I think people started to kind of kick off a lot of the activity, kind of to Sean's point. And then, Trump at the beginning of this year effectively just like nukes the market for fun. And so people kind of got a little skittish, I think. And, the Fed yesterday maybe like held rates steady. So like, I don't know that the party's like starting, but like, it's so hard to time it. Like, I don't know if you guys have a different opinion. I don't know if I would try to time it, but if I was going to make a bet, I would say like, the cycle probably like if you're in the like, if you can get to 50 million in revenue in the next 24 months, like I think you're going to be in a really good spot.
Why that number? Sorry.
50 is just like sort of like the general rule of thumb for like your like buyer universe opens up a lot. Like if you're under 50, like you can get like a lower middle market private equity deal done, but 50 plus like strategics start to look at you, like bigger private equity funds start to look at you. Like it's just generally easier to get something done. The EBITDA is the actual number, but
yeah, you should listen to the episode 1 of the finance operators because they talk about that. That's for the audience. I know Matt already listened. He's a subscriber. He's in there. I got 2 thoughts. Brad Gershner, awesome dude. I had the pleasure of meeting him a couple times, and
really,
yeah, dude, energy packed, so fucking fun, the best dude to hang out with. But listen to he did an interview one time, and he's like, look, he's like, $100 million exit changed my life. He's like, he had a company, he was the co-founder of it, and it was a $100 million exit. Now, this was like in 2000 or whatever. So like, it's probably like a $300 million exit today with inflation. But he's like, look, it wasn't these, multi-$100 billion companies. I didn't start one of those. I didn't start Uber, right? He's like, I hit to first or second base. I was able to buy a house and I was able to start an investment firm because of one of these minor exits. And we just shouldn't piss on, the $10 or $20 million exit. Like, life-changing money is life-changing money. And you owe it to yourself as an operator to take life-changing money as soon as you possibly can, right? That is like one of my main advice. So I had a friend and he was going to sell his business. He was going to get like $20 million after, investors, everybody else, right? And he's like, but I think I can get 200 million if I just hold out for 4 more years and build this thing.
Cool.
And what I told him is, I'm never going to talk my friends out of becoming multi-millionaires. I'm like, it's better for me to have rich friends. It's better for you to have 20 million bucks, right? Like, I'm never going to talk you out of having $20 million. So just secure whatever capital you can, and you can always build something else. You could be the Brad Gershner, right? He's worth $10 billion now, right? And started with that $100 million exit. So that's like the first thing. I don't know if you guys have a response on that. Then I'll tell you about.
Dude,
I have a question based on that.
Yeah,
when's Rich selling?
Dude, Well, if anyone's listening, they want to buy.
I've heard you say, I know you don't want to now.
I thought you said you were accepting billion-dollar offers actively.
Well,
Dude, I say a lot of shit. One reason I'm off the internet is I was just talking to my wife because I might have been back on Twitter by now by the time this comes out, but I'm trying to spend way less time on the internet because I was talking to my wife and I'm like, yeah, maybe every one of my thoughts shouldn't be on the internet. Right? Like,
no.
Yeah.
John.
Yeah, like, because people are like, oh, you tweet so much. Like, do you write? I'm like, no, if I have a thought, I'm putting it on Twitter. But Cody, you use the word family office, right? And Ridge is, we talked about running it like a family office. We actually just bought something for about 0.3x revenue. So we got like a very, very awesome revenue multiple. I can't talk about who it is or why I bought them. But
Gatekeeping.
Yeah, sorry guys. There's legal involved.
But
But
you know about exits and you're not even going to talk about the exits?
this is not a good exit for the guy I bought.
Oh.
But yeah, so like, we do strategic acquisitions occasionally, and we own real estate through the business. We have like 3 properties. Like, it's very much a hold co where I am one of 5 shareholders, and the other shareholders are my best friend and a family that I'm very involved in. So we kind of run it like a family office. So we might do that. But dude, I'm also down to sell. I'm getting older, man. My joints don't feel the same.
Dude, you're 30, what, 31? Don't talk to me about your joints not feeling good.
Well,
if
dude,
Panzer was here, he'd reach through the screen right now and choke you.
it's a young man's game. But Drew or I guess Matt had the really great question. Like, how do you time this? I've heard for fucking 5 years that there's $2 trillion in dry powder sitting in coffers waiting to be deployed.
Kind of why I'm asking.
And that number keeps getting bigger every time people say it to me. A different banker. There's a lot to unpack there. Dry powder meaning capital committed to private equity funds or VCs, right? But the capital hasn't been called yet. It is in other investments. It is in treasuries. It is in wherever they choose it to be. It's up to the firm to call it. But then you have a bunch of people who are mad at private equity, right? So private equity has pivoted to private credit. And this is so boring to fucking everybody on earth, but private equity. I love this. Yeah, dude.
Everybody but Drew.
This is awesome.
So private equity used to buy brands, okay, and then they would run those brands more efficiently, and they'd put debt on those. Oh, well, actually, that was just the first one. They'd buy brands from them efficiently, okay, and then the Carlyle Group is like, check this out, dude. We're gonna take $100 million, and then somebody's gonna give me $900 million, and I'm gonna do leverage buyouts. I'm gonna buy stuff with debt, and then I'm gonna be really good at the math so that I get a higher rate of return. That was like this whole modern era. That's actually been over for like 4 years, and private equity groups just do private credit now. They just want to loan you money because they can't find things to buy that are good enough value, right? One of my favorite private equity groups has moved away from commerce, and they're like, yeah, we just buy roofing roll-ups in the South United States. Like, that's what they're doing now, right? The point I'm trying to make is it's really, really hard to time. I've heard about this capital being available for so long. It just comes down to interest rates. When interest rates touch 3s, you will see a flurry of M&A activity because that's when the math starts working again. But Matt, you want to jump in? I know it.
Well, yeah, I guess like it's less about like trying to time the market, and it's more being ready when it starts to open up. Like, I think that's probably the better advice for people is like, Drew, I love the like a simple, like actionable, like 50 million. And there's probably like an EBITDA number that's attached to that at that point, yes, there's more buyers open to you. It's so interesting too on that, right? Like, you got to get to 50 with some kind of EBITDA. That opens up the aperture of buyers. But then also as you get bigger from there, it shrinks again, right?
Yeah.
Like you're basically, your total potential buyer starts to shrink. So this is actually like, if you're call it like a growing 8-figure brand in consumer, there's actually a lot of downside risk with trying to go past a certain point. So like the timing of it is actually around size of your business. Like there's probably an ideal size where like you are primed for exit. And that if you decide to hold on and go bigger, your probability of exit goes down because your buyer pool shrinks. And then you are really at the whims of interest rates. Like in that $50 million range, at least what I've seen, there's just so many buyers that like you can probably get a deal done in any rate environment. That's just going to be a question of multiple and deal structure. But then the other part of timing, guys, is more around like once it opens, what does a company need to do beyond revenue and EBITDA? Like, how do they need to be prepared to sell? Because I think this is the other thing. Like when I sold my first company, I had no idea the proctology exam that I was signing up for. Like I had no clue.
Tell us about it. Tell us about it.
No, it was violent and I've got PTSD. No, but like it was like a little under 90 days. And the stuff that they asked for, I'm like, we don't have that. Like, why would I have that document? Or why would I have this like mapped out? So I almost think that what's needed is like, if you are thinking about an exit at some point, is that you almost have to start treating your company as like preparing it for that outcome, right? So like start building a data room, reach out to some bankers and say like, this is the stuff that they're going to ask for. Like you can actually prepare for an exit. And it probably creates, you're probably an even more disciplined operator by doing some of this stuff, like buttoning up some of these things. And that when the window does open, now you can actually make it happen. Because I have been on the other side of this where we miss the actual window, you know, like because we're not ready to strike when it opens. And I've screwed this up from a capital raise perspective. So like actually getting money for the company. And I screwed it up with another company I own. We're like, we just weren't ready to sell and there were buyers. It's like, we were not even close to ready to sell. So like by the time we could get ready, they were gone. Like there was no way they were happening.
Most brands are leaving money on the table with SMS. Not Ridge. SMS is our #1 revenue driver, and Postscript is the reason why. SMS is an email. If you treat it like email, you're doing it wrong. Postscript gets it. They help brands like ours turn SMS into high margin, high ROI machines. We stopped wasting sends, okay? We would just randomly blast text to people. That was a bad move. Postscript dialed in our automations and subscriber LTV tracking. Then they brought us more subscribers, and more subscribers equals more cash. List growth isn't about getting numbers up. It's getting buyers in. Then they have AI-powered SMS. Instant conversions. They call it infinity testing, one of the coolest names in all of SaaS. We use it every time we send an SMS out. Postscript auto-optimizes for profit, and we're not getting fined. One SMS compliance mistake is a lawsuit. So Postscript is building for the modern industry to take into account all these ever-changing laws. The bottom line is brands are winning at SMS via Postscript. The results for 2024, Ridge had 1 million opt-ins, okay? We had 500,000 new subs, and we drove, I'm going to tell you guys, over $40 million in SMS revenue, and it's a 100% increase year over year. The ROI is insane, 100x plus ROI on SMS for Ridge. So if you want to try SMS like the pros, like Ridge, check out Postscript today. Thank you guys for being here.
It's a really good thing to bring up just because so exit readiness, right, is like you could go and pay a consulting firm to, do an exit readiness effectively project with you. And like when people say like, we're not ready to sell, like it's like if you hear it and you almost think like, oh, like they're not like, they want to keep going with the business or like they're not emotionally ready to part with it or whatever. It's like, no, like we literally just like haven't done like the Q of E or like our accounting sucks. Like I'm literally just like not ready. So there is like probably like a 6 or 9 month like preparation, exit readiness phase before doing it. It's a really good thing to call out, Matt.
Yeah. The other thing I see this too, like I know a guy right now who is preparing his company, his brand to sell. And I think he will sell. I think it's a really good business. It's growing at a great rate, got good profitability. It's in a good category. It's not consumable, but I still think it's going to sell. And he's going through the work now to get ready for this process. But the surprising thing to him is like, these are costs that he would never choose to bear as a business. Right? Like he would never hire these people, have these like he would never go through this in normal course of operating. So like that's the flip side of this is if you are going to go get like exit ready, there's cost to it. So like you also have to be ready to spend that money on like, and it's not growth money. It's not, Cody, like you and I this morning, we're trying to figure out how to spend more money on growing. It's not that kind of dollar. it is straight up like administrative. It's doing audits. I mean,
Yeah.
I'm sure. Are you guys audited? That's actually a great question. Sean
That
and
is a good
Cody, are
question.
you audited financials or you review?
I do a review. Cody, are you
Review?
audited?
I don't want
Oh,
to say anything
guys,
that's going
you're
to get
way
me in
too
trouble
big.
on here.
It's going to get you in trouble. Oh, come on.
Edit this part out.
Wait, so you guys don't have any?
We are
There's no
completely
debt.
GAAP compliant.
There's no debt at all on either of your businesses either.
No.
So I have it's between 10 and $15 million revolver with Chase, but no money's deployed. And they
They don't make you get audited?
They accept a review for the size. I mean, because the size of my business and the debt revolver, they're like, yeah, okay, we'll take a review. All
The
of our
Sean
money's with
Frank
Chase.
accounting review, yeah.
Yeah. No. I mean, we use Moss Adams, so we use a real firm.
Okay.
But I want to talk about missing the window. So we had an offer in 2021 from a public company to buy Ridge for $300 million. Okay. And I mean, that was over like 2x revenue at the time, right? Like I think I did $100 million in like 2020 or maybe 2021, something like that. So it would have been an awesome deal. Okay. And we're like, dude, we are totally going to take that deal. And we engage with a banker and we start going through that whole process. And the offer was just like, I would call it non-formal. It wasn't binding by any means. But when we actually started diving into it, we were not audited back then. We did not have an accounting function. I don't think I had a CFO in 2021. Okay. And so by the time we get our shit together, that company, which is publicly traded, the stock price was down 50% by the time I was all ready. So the deal fell apart. There was no way we're doing that deal. Okay. Since then, I've probably spent $4 million professionalizing the accounting side of my business. Right. So to go from, because you have to do historical shit, you have to fix historical stuff. And it always comes down to like, you can't do this year because you didn't do the previous year close right. And then that makes you go back to the beginning of that year. It is just a never ending fucking domino effect. So if you can afford it, do it right from the beginning. Right. So right now it probably costs me $1 million a year to be audit ready. Right. So that is, you have to pay, a real accounting firm to do your books, and that's like $250,000 a year. And then you have to have a VP of finance, a controller, a CFO, 3 CPAs. Okay, that's a bunch of salary right there. And then you have to pay for the audit. So the reviews are like $80,000. The audit's like 120 or something.
Yeah.
So it's like $1 million a year to be ready.
Yeah, we're a fully audited. I hate it. I mean, I'll just start by saying that I hate the audit process. I hate how much it costs. It's a requirement put on us from our institutional investors. Like I have like big institutions that have invested in us. I actually have government money, so like we have no choice but to be audited. It's expensive. Like being sort of like financially buttoned up. I think Sean is a great point. Like if you're a 5, 10, 20, $30 million brand, like I don't see too many companies that size buttoned up financially. Like they're probably not even doing reviewed financials because they can't.
I think like what's like, yeah, I agree. Like everyone should be doing that, but like why is like kind of the question, because like, yeah, Sean, like if you like would have pursued, like, it sounds like maybe you went down the path a little bit, but like if you would have pursued like this $300 million deal, it would have ended up a $200 million deal by the time you closed if you had like none of your shit together, because they just take every little thing that like, you don't have ready and they just use it against you. They just tit for tat, like get the purchase price down over time. And then like, you're at the 1 yard line and you're so, burnt out that like, you're just going to take whatever they end up offering you. So like you can like, it costs you $1 million a year to do it, but like, it's probably worth like 10x that when that day comes that you've actually made that investment already.
Yeah.
Yeah. So it gets you access to different debt. But then I was going to say to Cody, when are you going to do it? I guess is my question.
Yeah. When are we going to audit or sell?
Audit.
We're in talks of it because we're trying to get ready. We're not going to be, there. The one thing I guess it's related to, I want to add, like kind of like Drew's point of when you get to 50 million, like your buyer pool goes up and it goes down. I also think you have to be really honest about your like growth trajectory and your competence as an operator. Like we've grown super quickly and we have no desire to be wholesale, and that would grow our business a ton. But like, I don't know what, past $200 million of revenue looks like for us D2C plus our own stores. Like I certainly don't think I'm the person to do it, and so it kind of like forces you on timing, and fast growth can. And like when you're at, 25 million and you're growing to 50 in a year, like you can think you're going to double your business every year, but like you got to be honest about your TAM and your growth rates, and like it will plateau at a certain point, and you don't want to miss your own window as well. So you also have to time your own business and your growth as well.
Yeah, growth ceilings are a real thing, right? Like every company hits them. And that's actually like, that's why I bring up this timing thing, not from a time the market, because nobody can do that, but it's actually understanding when you're ready. Like from all, it's, you try to like consider it like, Drew, you call it exit readiness. That's like a operationally and financially thing. That's also a, hey, our growth rate has been pretty steady the last few years and it looks like it's going to maintain. And Jason, who's not here right now, and I know he's chirping us in our freaking chat while we're talking, but you know, he has brought this up. We're like, the most important thing to when you're thinking about an exit is like, do you have to do what you say you're going to do? Right? Like if I'm going to hit these numbers this year, you have to hit them, especially if you're in a process. You have to hit or beat in process. You can't go into an exit process not confident that you're about to smoke your forecast, right? Because like all buyers of all classes, whether that's PE, strategic, like a strategic backed by PE, or just a straight up big strategic, they all have teams of people paid to say no and looking for reasons to say no and looking for reasons to discount you down, right? So the readiness and timing is actually, there's quite a bit of things in your control. That's not it's not like macro dependent.
Yeah, and it's so much shit that you wouldn't expect. They want to see history of you having projections and then beating them, right? Which like a lot of times we're just like, we're going to try to make as much money as we possibly can this year. Like, and they're like, that's not a projection, right? And Cody, I know this is the way you run your business too. We have a daily growth dashboard that tracks like revenue and sales and profit by like all these different categories. It's in Google Sheets. It updates automatically. And you know, I was in a meeting and I'm like, yeah, this is how we run the business. And they're like, yeah, but where are the QuickBooks reports? And I'm like, oh, I don't look at that. I look at this thing. It's every single day. And they're like, you have a bunch of people who don't know how to run businesses, and you have a bunch of special ways to make your business unique. And that's like their kryptonite. They hate that. They're like, no, they want to see the spreadsheets from the books they read, right? And that's why it's so hard to get deals done.
They are weirdly man, I wish I knew this stuff too when I sold. Like, buyers of all stripes and colors are looking for predictability. That's probably like one of the core things that they seek is how predictable is this business? And what you're talking about, Sean, is like, you have a history of being predictable. That's kind of, because like if you're not predictable, which consumer, it's arguably very hard to be like accurate over time. To them, it's just like, I don't like that. Like I can go buy something with contracted revenue. I can buy a roofing company, like where there's just like, I'll buy a roofing company in a tornado zone. Like
I think
way more predictable.
Predictability and like durability sort of go hand in hand here too. So like, I obviously like track basically every deal that is like with anywhere close to sort of like what we care about. And like one of the data points I think is really interesting is like the average age of one of these brands that I just pulled up that got acquired since like 2023 I started doing this. The average age is 30 years. And like average may not be like, so like average may not be like the, you know, best metric maybe, but like, you know, like these companies have been around for literally ever. Like, you know, when Mars buys Kellanova, like that's 100-year-old business, right? Like Aesop started in the 80s. It's been around for 40 years. Like Poppy was actually kind of an outlier, and Ghost was actually the quickest. So Ghost was around for 8 years before they got bought by KDP. Like the valuation was 1.6 billion. And when I read that deal, I was like, this is what stands out to me is how quickly they did it. And like Poppy, you know, Olipop, like they started in 2019. Really, Olipop did. So it's like,
wow.
Yeah, like I don't even know that like somebody would clearly buy them obviously because Poppy just went, but like these big buyers, like they really do want like Chapstick, you know, who's been around for like 150 years, right? And it's like those are, you know, they just got sold to Yellowwood, which is like a big Boston-based sort of consumer private equity shop. So it's predictability, but like predictability over a long period of time. Otherwise, like you open yourself up to this like idea of fad risk, you know, where it's like you grew too fast.
Is your customer service team drowning in support tickets? That was us before switching to Richpanel. What if your team could focus on conversations that truly needed a human touch? Well, Richpanel is an AI-first help desk built for e-commerce. We've been with them for a while, and we've accomplished 3 things already. 1, we've immediately cut our customer service costs by 50%. That's more features, better support, and instant impact on our top and bottom line. Boom! Savings. The automations didn't compromise customer satisfaction. In fact, we're at an all-time high with a 92% customer satisfaction score. Our customers are happier, our agents are happier, and I'm happier because of the savings. I'm on track to save over $500,000 in CX hiring costs thanks to their AI. Now I can tell Connor to take that money and put it right into Meta. Join the 2,000 7, 8, and 9-figure brands that have switched to Richpanel. Save money, save time, and improve the quality of your customer support. The Richpanel team's amazing. They're going to be on Slack with you. They're there to help build custom features to make your life easier. If you want to slash your customer support expenses by 30% and reduce tickets by 30%, go to richpanel.com/demo. richpanel.com/demo. Demo. For the final time, it's richpanel.com/demo. Tell them the operator sent you. Tell them you've never heard of Cody or Jones Road Beauty, that they did not send you. It was the operators. Thank you so much. Goodbye.
Okay, so Sean, Cody, this is so like, you have to go here. How do you guys then respond to the hyper growth D2C sort of like chatter? This is what everybody wants, is they want to get as big as possible, as fast as possible. But then weirdly enough, like it's almost a negative signal. Like if you get really big, really fast and you think like, I'll just get to $50 million in 3 years and I'll sell. I'm like, oh, homie, like, let me tell you how the private equity guys are going to look at your 3-year, $50 million growth rate. They're just not going to believe it's going to maintain. Like you're not actually going to get any kind of significant multiple, because it's just, you're full of shit if you think it's going to keep going.
We grew too fast last year. Like we grew 50% last year, and we probably should have grown 25%. And it was just, ignorance tax. It was just, let's spend as much as we can and let's get as big as we can. First of all, now the market sucks, and so it's going to be a lot harder to growth and comp that. So we can't grow 50% anymore, but even if we could, we couldn't try to. But I think of just shifting as much of our business to own brick and mortar with direct mail. And if we can get that working, maybe we're not 50% growth ever again, but maybe you grow 10, 20, 15% a year, maybe less profitable, but it's just so much more stable. So that's like my vision for just de-risking it and getting, less volatility over time.
It's just so incredibly unsexy. Sean, I love it. It's just like the boring, this is what makes this is where I think consumer is actually durable, is when you take a much longer view.
Well, Cody said something very correct, very prescient, that fast growth leads to hard comps, right? So, he's like, oh, I grew 50%. It's like, okay, well, you have to comp that now. That is now zero. That is now 0% growth. The really hard, impressive thing you did, you get no credit for it on January 1st, right? The other thing is you should understand what best-in-class growth is in a category or in a year, and then don't try to beat that, right? So last year, best-in-class growth was probably 25%, right? And now Cody 2x'd it. He gets no credit for that. Like, even if he did a process, they'd be like, yeah, well, 25 is our 50. If anybody did 25, they got all the points in the test. You scored 100 out of 100, but really you get 150, but there's no extra credit here. So you should understand best-in-class growth, and you should try to hit that. Me and Drew have a friend, and the business did like 40 million last year, and they're like, yeah, we're going to do 160 this year. And I got on the call. My first thing I said was, don't. And I was like, don't do that. And they're like, no, man, it's going to work. We have everything lined out. And I'm like, no, I'm telling you, future you, I've been you in the past. Okay. Like, future you doesn't want you to do that. You should just try to double. Doubling gets you all the credit. 4Xing doesn't get you any credit.
Well, you guys know what a really good example of this is Hero Cosmetics. So like Hero Cosmetics grew, I think they got bought by Church and Dwight for like 630 million or something. They were doing 100 million in sales. I think literally 40 million in EBITDA. And they sold for like 15x EBITDA. And like, okay, like, home run exit. Like that was an awesome team, awesome brand, like one of the best stories in consumer of the last decade. Like I'm taking zero credit away from them. But like I had like many conversations with bankers because I kept looking at it and I kept going, okay, like, you know, what was the ASOP EBITDA multiple, like 22 or something? Like they were growing so much faster and they, you know, they were so profitable. Like, why was this not $1 billion brand? Like, why didn't it trade for 20x? And, you know, the answer was at the time fairly novel because this is, you know, a couple of years ago. And it was like, well, they were growing so fast that like Procter and Gamble and Unilever, like, who, you know, those are the folks that pay $1 billion. Like they weren't even at the table because like they looked at it and they were like, it's, you know, there's too much fat risk. Like, because I think they went to 100 million in like a handful of years or something crazy.
It was really fast.
It was like something nuts, like 4 years maybe. Well, I guess that's maybe not nuts to you guys. You guys both probably did that, or all three of you probably did that.
It took Rich forever. It took us fucking like 8 years.
Oh, really?
And that's with COVID. I mean, we started on Kickstarter 2013, so it took us a long time. But the other thing is, the question was, you know, racing to 50 million, right? Like, okay, at what point do you get credit for your growth? And you should look to Hexclad because it starts to look real when you do 200 million and then you do 400 million and then you have growth on top of that. Like that's when people are like, oh, it's a multi-$100 million business growing really fast. I mean, I shouldn't say anybody. It's really, really hard. You shouldn't do this, but you can go from 5 to 50, right? You can go from 10 to 50, but then they're like, oh, can I really get to 100? Can I get to multiple hundreds? That's when you start actually getting credit for that really fast growth. But nobody here listening to this is going to do 200 this year and is going to do 400 next year. Like those are such outlier cases.
It's incredibly outlier. Sean,
I don't even know if that exists. Yeah.
It does. Honestly, Jason's like, I keep telling Jason, like, dude, the Hexclad is just so unique in so many ways. Okay, so Sean, on that, and maybe Drew, you might have an opinion on this, but like, at what size should an operator start to think about predictable growth, not hyper fast growth? Like, is there a revenue number? Because there's no doubt that like when you hit product market fit, you can go from like 0 to 20 or 30 pretty quickly. That's just like the beauty of consumer at this point in time. Category dependent, just asterisk there. When should they start to be like, you know what? No, now I'm going to go for like 20, 25% per year. And I'm just going to do that over like a decade.
Is the question for me?
Yeah. When do you think that is? Is that 30 million, 40 million, 50 million? Like when should somebody start to be thinking like, I should actually be far more predictable, far more calculated, resist the urge to like try to double all the time?
Yeah, I would log out of Twitter. Nobody should double at all. Okay, you just heard Cody, and Cody's probably the smartest of us. Like in terms of the operators, I'm thinking about the ultimate operator chat. Like if I had to give the reins,
Cody's the brainiest. Yeah.
Just like I mean, he's the most thoughtful. He's the least bombastic. He's probably the smartest one. He's like, yeah, I grew 50%. It was too much, right? And so. You shouldn't try to double. I would honestly, if I was in consumer today, I would do as much organic as possible to get to $5 or $10 million in revenue. I would then find some sort of subscription or add-on product that can get me reoccurring revenue. And I would try to manage it with as few people as possible. I'd pull a Dan McCormick, basically. The guy from fucking Create Gummies. That guy's doing it the best. And I think he grew really fast.
Jason better be listening to this because we talked about the DTC 3.0 and then he just starts subtweeting us. And I think like whatever you call it when you're on a podcast and you come after somebody, but because I'm all about like lean OpEx and like Connor and I love the 3.0 and Jason's like, no, these guys don't know what they're talking about.
Well, dude, okay, that's Ecom Grandpa. I'm like, Jason from his, he doesn't even have an He doesn't even have an ivory tower, dude. He has a tower made of pans. Look, obviously Jason is way more successful. He does more revenue than all of us put together. Fucking the guy's the king. But if I was starting today, I would look to Dan McCormick and Create Gummies, being like, look, it's low SKU count, very simple subscription revenue. And he could probably just grow 30% per year and he'll beat all of us to $100 million exit, I think.
Jolie Skin is a really good example of that too.
Say Jolie, Zach. I mean, I know Hollow's not subscription, but I'm sure Zach will cook up some other subscription stuff. So I totally agree. I think first of all, you're way too kind, so I don't believe any of that shit. But you also have to like, my business didn't get 50% better last year. Like I think it's the analogy I've been using is like when like your warehouse or your manufacturing can't support the growth. Like we've all been through that on really quick stuff, but like internally, like our ops, like our growth team, our marketing team didn't support it. Like I don't know if I am like forced to, but like 50% better as a CEO. Like it takes time, and you have to be really realistic about like your capabilities, either as a founder or an operator, or like your teams. And like to continue that growth, you have to make sure you're doing it sustainably. And when you grow 10% a year, 20% a year, you're probably going to be a first-time founder. You're probably going to make a lot of mistakes, but you can figure out those mistakes. It's much easier to get 10% better every year, 20% better in terms of like your own capabilities. But like not that many people or not that many like organizations can also handle that growth. And like it's so much more painful in so many aspects.
Also,
100% agree.
Grow for why? That's the question. It's like, okay, I'm gonna grow. It's like, okay, do you want to manage more people? It's like, or you just think growth is good, right? If you're not trying to exit your business, or just be very tactical.
So you grow 50%, 100%, your expenses are probably going to grow similar with it. When the growth of revenue comes down, it's actually really hard. You think the growth of expenses are going to come down outside of marketing cost. It's very hard to get those back on the right trajectory. And that's going to be much more painful. So agree with the stay as lean as you can.
Because I'm going through that right now. I'm like, I want to cut 5 people. Matt, sorry, I'll let you talk.
No,
man.
no. No, 100%. Go.
I want to cut 5 people, right? And the amount of hair pulling, the amount of back channeling, the amount of you should cut from that team, and that team being like, no, cut from that team. Like nobody. Everyone's like, I need everything I have and then actually a little bit more. And this is like what the government's going through, right? Like everyone's like, yeah, there's plenty to cut, but it's actually none of my stuff. It's all of your guys' toys we have to cut. So yeah, that's why it's just so much better to be smaller, right? Like you can be more nimble, because going back on any of those things, I'm just talking about a tiny little haircut. I think we can be a little more efficient, and it's so painful internally. But Matt, go ahead.
No, I couldn't echo that any more than what you just said. But when it comes to exits, I think what you guys are hitting on, and I think like for the people listening, the like fast growth rate is another one of these traits that we've borrowed from tech, like from the SaaS world or like consumer tech world, that doesn't transfer one-to-one to consumer, right? So like when we're talking about consumer goods exits, there are absolutely outliers, but most of us aren't going to be an outlier. Like, so the real game, I think here, is a game of probability, right? And, as an operator, you sort of have to look at everything through this lens of like, how probable is an outcome, like an actual exit, going to be, and play to like maximum probability versus maximum size. And I'll give you guys like just having seen a lot of deals, not nearly as much as Panzer, but like still enough, and having gone through one to completion, the probability, like I wish I knew this, but like the higher the probability of the deal also means that you actually have a more friendly deal structure too. Like, and structure is the thing that like everybody pays attention to headline numbers. Like the company sold for 100 million or 50 million or 20 million or $1 billion, whatever it is. But like the thing that we usually don't get a look at is structure. And as an operator, that's the thing that I'm telling you now, like that's the thing that you will care about more.
So running an e-commerce business at scale isn't just about great products and marketing. It's about precision. And when you're operating at a high level, 99.9% accuracy stops being nice to have and becomes non-negotiable. That's why I'm excited to talk about our experience working with Saras Analytics. They've given us real visibility into the numbers that matter. Things like product level COGS, supply chain costs, inventory optimization, all of our marketing metrics. That's just the start. We're estimating 2 to 5% efficiency boost across the board, improving customer retention, making our marketing dollars work harder, and ensuring we're operating smarter as we're getting bigger. These aren't just minor wins. They compound over time to make a huge difference in profitability. But what I really love, the cultural shift this brings. When teams have clarity on the data Collaboration improves. Finance, marketing, and operations aren't just working in silos anymore. They're making decisions together with the same source of truth. It's not just about insights. It's about execution. I talk about this all the time, execution. So if you're scaling your e-com brand and need that kind of accuracy and efficiency, you need to talk to Saras Analytics. It's been a game changer for us.
I always say, tell me your valuation and I'll build you the contract, right? Like
100%.
I'll pay any amount of money over a long enough period of time. I was talking to my wife
just wrap
last
it in
night.
structure.
Yeah. I was talking to my wife last night. And I'm like, I'll give you, I think it was $100 billion over 1 trillion years. And I'm like, yeah, I'll give you $10 a year, man. I got no problems. Yeah. So, the deal that we did, the reason why it's not I'm not going to disclose it, but it's not a good outcome, right? It's 0.3 revenue, seller financed, 10% upfront, paid over 24 months. So it's like, oh, that's, if you think about that, it's like, oh, that's not good by any means, right? So yeah, a lot of times people are like, oh, I want a $1 billion company, and then they'll have 5x preference on top of it, but maybe not 5x. Drew, I don't know. Have you ever seen a 5x? I've seen 3. Have you ever seen?
I've seen a 5. I have. There's actually a famous. Yeah. So hang on. You're talking like a 5x pref, Sean?
Yeah.
Yeah. Okay. So it's a public deal now, but there was a company. It's an older exit. Drew, you should go study this one. But there was a protein powder up here out of Vancouver called Vega. Charles was one of the founders there. He owns a fund now called Lyra Growth Partners Lyra Growth. Lyra Growth. Anyway, Charles is a super smart operator. They sold Vega, I think it was like $400-$600 million, but he had private equity money in them, and he had a freaking 5x pref on the money.
Oh my God.
Yeah, dude. And he beat it. Like, that was the craziest freaking thing, is like it worked out where he smoked it. But you talk to him now, because like when I'm in Vancouver, I often will see Charles just to hang out and drink kombucha or whatever the fuck he's invested in his office. And he talks about, he's like, literally, it's public information, so I'm not disclosing anything, but like when he did that private equity deal to bring in some cash into Vega, it was on a 5x pref, and he said it was like one of the most terrifying things, but he was so confident that he would beat it. But like, my advice to people is, don't do that. You're not that good, and you're definitely not that lucky.
Yeah.
I mean, he must have won so hard on that valuation that his dilution for whatever that private equity, he
killed it.
That's a ballsy move,
dude. It's just, but again, outlier, right? Like, I guarantee that if he was sitting here today, he'd tell you, like, that's a bad deal. Like, you should never take that.
Yeah, there was probably no participation on it, right? Like,
that's what I was just.
No, it was not participating. Yeah,
you couldn't possibly.
So,
oh God, no.
Yeah, to explain what this means to the audience, because people are probably hearing us freak out about
and
something. Yeah. So, let's say you have a business and you need $10 million and you really want a $100 million valuation. Okay, but I don't think the business is worth that. Instead of fighting you on that, I'll be like, I'll give you $10 million. Your valuation's $100 million, but you guarantee me I get $50 million back before you get $1 of it. Okay. So the business goes to exit. They sell for $100 million. You own 90%, but I get my $50 million first. So I get 50, you get 50. Okay. Now, if the company sells for $1 billion, okay, and then this is what participation means. If it sells for $1 billion, my 10% is worth $100 million. So you cleared my preference. So then I get my 100, you get your 900. But if I'm participating, okay, that means I actually get, and like the math gets a little weird, but I'm pretty sure the way it would work in this deal is I would get my 50 million and then 100 million on top of it. So I'd actually get 150 million on top of that deal. So it's like,
and that's just the liquidation preference. I mean, there's like, you get really into the weeds, but like another low key rug out of PE is like the cumulative dividend, like a compounding 8% cumulative dividend. And you take the money in 2020 and then you sell your business in 2030 and you have 10 years of 8%. And then you get rugged that way. So like, I mean, there's Maytav and I talked a little bit about it. There's a million ways to get rugged. You need a good lawyer.
You need a good lawyer. This is the thing. Like taking investment is, I think, is like first time founders. I really advise people not to. I mean, obviously, like in consumer, you just probably shouldn't. There's not a lot of reasons you should have like outside institutional capital in a consumer company. And then as first time founders, like there's just a good chance you're getting screwed. Like the investors, like all good markets have, like, you've got operators and you have capital, right? And operators, in my experience, like to poke fun at the capital people because like they don't know how to run a company. But like at the end of the day, like the capital people are really good at deploying capital. That's their job. So what we're talking about here on the show is like, you can't talk about exits without acknowledging that like the other side of the equation is there's a buyer, and that buyer is actually a pretty sophisticated buyer. They might not be a sophisticated operator. We hear a lot about that. It's like, oh, bought company, screwed company up, company goes out or gets bought back. But like, that doesn't mean they're not a sophisticated buyer. So they are going to value you through their lens. And that's why like durability, predictability, if you're going to build a consumer company or any company and you are thinking about an exit, you actually have to like you actually have to put your sort of buyer, banker, investor hat on and start building from their perspective.
Well, Matt, so well said. And I'm actually going to, it's like different languages. Okay. Like,
yes,
because those deals as an operator, you're like, they bought the company, they messed the company up, and then I bought the company back. That could actually be a good investment from an investment perspective because they took a fuck ton of debt out on the business. They recapped themselves and they have a shell of an asset. And as an operator, we're like, you ruined a company, right? But from their perspective, they made 30% great IRR,
baby. Yeah.
yeah. And so it's like the ends justify the means to them, right? We're like, we are creating a beautiful thing. We want it to be self-sufficient and thriving. And that's actually probably not their objective, right? So yeah, it's just understanding the nuances here. There's a lot of different ways to win, and sometimes we're at odds when it comes to those things. Well, guys, we've been at this for an hour and 6 minutes. I got some questions for you that don't have to do with exits. If we can end it, okay,
let's do it.
Cody, you are a leading voice of the operators, the marketing operators, and then Drew, you're the newest show on the network, Finance Operators. How's it going? Like, how's the podcast? How's working with everybody? Do you like it? I'd like to include this in. Cody, do you have any complaints?
I got a few with, no, I love it. I can't believe I haven't met Connor. I think I've been on a call or a podcast with Connor, your CMO, twice in all time. One was probably 2 years ago. And then another one was when Connor R was out. So I can't believe we haven't met in person, any of us. So that's my biggest complaint. Hopefully one day this year soon, we'll get to meet in person, hopefully do an in-person pod. But no, it's a ton of fun. You guys are also smart. I listen to operators every week, not to blow too much smoke up your guys' ass. And it's really fun to get to learn from them, get to learn from HexCloud, who's obviously way ahead of us, and Connor, who how smart he is.
Dude, yeah. So I wasn't on the operators this last episode, like 101, 102 maybe. Dude, Mike is so smart. That's the thing. I'm like, you guys are so good at podcasting when I'm not here.
That was the goal. We're like, we need to produce a good show so Sean doesn't give a shit. That was, dude, you guys
got to get on the pod with Maytab. I mean, I am almost exclusively doing this so that I can talk to him for an hour or two a week. I mean, that's the smart. I knew he was smart from his Twitter, but when I started doing the pod stuff with him, I was like, holy shit, this guy's actually 3 levels above me.
Dude, I feel that all of us. And then Drew, how is the kickoff of the show been?
It's been a ton of fun. I mean, I love this. I was really glad that I got to be a part of it, and Maytab agreed to kind of do it with me. And I think we're gonna maybe even like ramp it up a little bit. Like, we got a lot to talk about, and we're having a good time doing it.
Hell yeah, guys.
Again, growth rate, Drew. Just save stuff, save it. This is the thing too. Like, I think when we started the show, I'm like, man, we could do like 30 episodes in 2 weeks. But I'm like, but we run out of shit to talk about. So like, let's pace ourselves here.
Yeah, fair enough. Yeah,
Drew, you know what you guys should do? Because I like this stuff and like the bigger picture market stuff. But Maytab is also super tactical. Like, I've heard when he was on operators, like if he just walked through, like he told me to get the book Double Your Profits. Like if he just like walked through tactical tips for like negotiating or cutting costs or stuff like that, he's just so good at that. Like,
have you listened to the pod yet?
I'm like 20 minutes in the first one. Did you guys do it?
Okay.
It was still market stuff when I was in it.
Yeah, the last 20 minutes of every pod is Maytab's tactics.
Oh, perfect.
Oh, so good.
Yeah. I got to get to the end then.
Oh yeah,
I hope he gets into some of the gray hat shit too, because he's got that guy's got tricks for days.
He's in the grungiest weeds.
Yeah.
Dude, he's comfortable doing things other people aren't comfortable, and that's where the alpha really is, right? Like sending a message to your vendors, I'm not paying you, what are you going to do about it? Like that's alpha, dude. That's how you can unlock some stuff. We all play too nice.
He was pitching us. What was he pitching us in chat the other day? It was a Indonesian real estate thing or something. And you're like, this is a scam.
yeah. He's like, dude, Meetup texts me and he texts me about it and he's like, guys, I have an investment opportunity, value add Indonesian real estate. What?
I was like, this can't be true.
You're not seeing that money back.
I'm like, you're building water parks in Indonesia? What the fuck are you doing, man? Oh, all right. This has been awesome. Cody, Drew, welcome to the family. This is a good episode. And I would love to do a crossover episode every week. This is mostly for my own enjoyment because I listen to every operators. I listen to every operators, listen to every finance operators. We should just do the cross operators, man. It's a new show. So I want to thank Fondue for sponsoring that new show too.
How about that ad read?
Yeah, dude. I use Fondue. There you go. Put that in the ad read. It's a really awesome thing from Postscript. I love Postscript. I love
it. It's pretty awesome.
Love Saras. Love Northbeam. Love Richpanel. Drew and Cody, what do you guys have to say?
Moperators, come follow us on Moperators. Watch Moperators. I was waiting for Drew to go.
Cut.
All right. Well, guys, introduce yourself. What's up?
Hey guys, I'm Samir. I'm the CEO of HighBeam. HighBeam is a financial platform for consumer brands to manage cash flow and profitability. What does that mean? 3 things. 1, access to the best financial products. 2, the automation to make them actually usable. And 3, hopefully the intelligence to help you make better business decisions. And so you don't take my word for it. I brought along one of our best customers, Sib from Branch Furniture. So I'll let Sib introduce himself.
Nice. Hey, I'm Sib. I'm one of the founders of Branch. We sell work products, primarily office furniture, some other cool things too. And we sell to both consumers and businesses. We've been around for, 6 years now, 6.5-ish. Team of 70-ish, based in New York and Toronto. We love Samir. We love HighBeam. And
Toronto. Yeah. I used to live in Toronto. There we go. Dude, we're all going to be friends. This is awesome.
I'm Canadian as well. I was born in Hamilton.
Oh, right on.
Matt, I'm going to do one better. In front of me right now is a Branch laptop stand. These guys make the absolute greatest laptop stand. Okay. So if you're listening to this right now and you're like, hey, I need to look as handsome as Sean on my computer. Dude, you guys really, best in class. I've looked at a bunch of them. You guys are some of my favorites. So
love that. I actually should be using it right now.
It's super cool. Like we've not had anybody from furniture on the show. And I think Sean knows this, but like I grew up in a family where like we ran furniture retail stores. Like my grandparents did, my mom did, my uncles did. Shit, at one point I worked in them. It's a hard ass business, dude. Like this, you did not pick a great category. Like wallets sucks, phone cases suck, drinkware hard. You just decided to like kick the hard bucket over the line and just go into shit territory. Like what?
We picked the Bulbasaur as our starting Pokemon. Yeah, we made it as hard as possible. No, there's pros and cons to the category, but I feel like each of us has our own crosses to bear. I know, Sean, you talk about the wallets and the lack of repeatability sometimes, but with Branch, the B2B story was where we started, and that didn't last very long with COVID. Consumer furniture is definitely tougher, but we've made it work, and partly with folks like Samir helping us, but we can get into all that.
Okay, so tell us why and how you use HighBeam. Why'd you pick it? What does it do? I'm gonna be cards on the table. I'm in the middle of onboarding. I have a signed deal to work with HighBeam. I'm paying for it. I don't know if actually it's a free. Just tell me the whole fucking product. What did I sign up for?
Yeah, love it. So I guess I'll start maybe with just a little context, which is that, we talked about furniture being a tough category, right? And I think that's part of why Branch has been kind of from the beginning very, very concerned with profitability and efficiency. And we're venture backed, but we don't really run ourselves like a venture backed business. We run like we're going to die every year, because every year we've probably almost died at some point. And so I think what we're thinking about our banking partners, right? There's a couple of things that matter to us. And kind of all of this is maybe in the shadow of the SVB stuff that happened a couple of years ago as well. One is we want like a reliable partner. Like we don't want to fuck around with this. You know, if that's allowed to be said.
Oh
but
yeah,
yeah.
You
Okay.
say anything you
Nice.
you're good.
Hell
Yeah, keep going.
We want a reliable partner. We want a counterparty that we can trust. And so we're pretty skeptical, right, inherently of neobanks and kind of all these innovative blah, blah, blah solutions. But let's just say step one, reliable. Step two, ideally, we want a partner that is helping us do some of these basic optimizations for profitability with way less work and attention from our brand, because we've got a lot to do, just like you guys. And so kind of automating things like treasury management and like sweep stuff that we kind of did manually before. How do we take that off our plates and still reap the benefit? I guess the third thing that we were looking for is more of like a strategic partner, right? Where banking is high stakes and working capital and treasury management and e-commerce in general is really high stakes. And I think you guys have talked about this in various tweets and blog posts and here on the podcast. But sometimes if you mess up with a forecasting decision, like you just find yourself in trouble way faster than you think. And that's compounded when you're growing really fast. Maybe when you're a mid-sized brand, you don't yet have the clout to negotiate those amazing terms with your suppliers. And so how do we get a partner that is like kind of like a fractional CFO, but we don't have to pay for a fractional CFO? And maybe they can give us some of these insights in a more reliable and automated way when we're maybe going to run into trouble or see around a corner that we don't necessarily realize when we're making a big inventory purchase or decision. So reliability, I think tactical automation, and then strategic partnership. That's like my 3-bullet framework for what we were looking for. And I don't know, HighBeam was probably the only bank we have interviewed that we've ever talked to that was a real shot at doing all three with us.
We designed this only for consumer brands, right? So people ask, like, why would you build a financial platform? No other financial platform is really vertical specific. Like your bank banks everyone, your credit card goes for everyone. Like, why build a financial platform specific for consumer brands? And I think consumer brand finances are one quite difficult. You have like unit skew economics, you have tons of daily inflows and outflows. And so using the financial products just to be able to automate them to actually get value from them is difficult. I'll just give you an example on the treasury side. Like most people run their business out of a 0% checking account, right? And that's not a big deal if you're running, variable inflows and outflows, and you can move money back and forth. But what we realized for most 8-figure and 9-figure consumer brands, if we could just give them a 2.5% checking account, a 4% instant liquidity high yield account, a line of credit, and automate the money in between the movement daily, like that's worth $100,000 to someone to be able to do yourself because of the fact that you have all this money coming in and out every day. Different than a services business or a tech business. So we'll go build a solution to try to automate that for this specific use case and provide that, which hopefully adds value. It's the same thing we've tried to do across forecasting and cash modeling and all of that. And by focusing on one vertical, we hope we can add value to Sean, you in the future on things like, how can I get a live cash flow forecast that's reliable, that helps me make better decisions on what can I do with my cash? Can I make it used more effectively? I think the small things that add up, once you have a business of that scale, it's hundreds of thousands of dollars.
Yeah. But can I just add one more thing? Like, I think something that's important is that you guys also nail the basics, right? Like I'm not logging into SVB's client portal anymore. And that itself, like God bless, our friends at SVB, but that is worth a lot right there. It's a clean interface, $3 million of FDIC insurance. It gives us a lot of peace of mind, right? Like it's the foundation, I think, to getting us started and starting to take advantage of some of these other amazing services that you guys offer, like the cash flow management, the auto sweeps into the high yield accounts. But it starts with like, you guys have a rock solid basic product, right? And I think from there, we start to get even more excited about the additional functionality that exists.
Sean, I don't know about you, but like the interesting thing to me is when I talk to a lot of like sort of call it like 10 million to 30 or $40 million brands, banking sucks. Like this is sort of like when they get over bitching and moaning about advertising, it's inevitably you wind up in a like, hey, how do you guys get a line of credit? Or how do you guys, like, my bank is an asshole. What do I do? It is like it's like the telecom of consumer. You know, like banks exist to just not be liked.
Yeah.
It's like they're in the business of dissatisfaction.
No, look, and we have been talking to HighBeam for a while, right? And so, our banking, here's Sean Frank's banking journey, okay? We have a Mercury account, which, we do with whatever for like small inflows, outflows. Most of our money just actually sits inside of a Chase account. So I'm probably sitting with, it's multiple millions, if not $10 million just sitting in a Chase account, earning $0. And getting Chase to give me a line of credit took like 8 years of working with them, right? Like I was on a call with them, yesterday, and they're like, Sean, we are so happy to announce you are officially a small mid-market customer. And I'm like, Jesus Christ, man. Like you have all of my money. I've been with you for 10 years and like you're still calling me small. And we've been talking to HighBeam, and I have a VP of finance, his name's Ariston, and I always bitch at him that I think we have too many people on the finance team. And I personally do all of our 13-week cash flow forecasts. So every Friday, I'm in there individually pulling all of our statements from all of our accounts, who we own money, everything. And Eric comes to me and he goes, Sean, HighBeam can do all of that, and we could probably get rid of an accountant. So I'm like, damn, dude, sign me up. I cannot wait. We have a 7-person accounting team right now. I would love to get to a mean 6. But with that being said, Samir, do I pay for this? Like, what actually is the product people sign up for?
Yeah, so it's a great question. There's 2 products. There's all of the banking features and automation associated with the banking, and that comes for free. So we only work with customers of a certain size and larger, which is why we can do the best-in-class service and all the things the big banks, for whatever reason, don't think you're big enough for. So you have someone's cell phone number to call, all those things. So the banking and the automation associated with it is free. What we're now trialing for free as well is the AI intelligence layer. So the cash scenario modeling, forecasting, which you have a 4-month free trial for. So that's set up with, is part of the intelligence layer to say, can that add enough value where you don't have to hire that extra analyst, where you can get that free cash flow, 13-week cash flow statement automated? That comes as part of essentially a SaaS fee, which is what you're paying for. But again, only if it adds enough value where it's adding enough stuff so that you can say this is worth what that is. Does that make sense to answer your question?
Yeah. So day one, I'm getting a free bank account like any other bank account. I'm putting my money in there. I'm running transactions. And you guys are like, we're better than everything out there because we're built specifically for e-commerce. And we're going to give you a return on the cash sitting in here, right? Chase just lends it out for mortgages, and I don't get any piece of that. But they're like, hey, you're going to be getting at least 2% right off the top on that, right?
Actually, probably higher than that. So what's interesting is like the banks had like record profits in 2024, partly because there's this, if you're Microsoft and you have a 100-person treasury team, you're doing this manually. But if we can do it for scale for 8 and 9-figure brands, exactly what you said, which is like you have 2.5% of your checking account, but the automated sweeps to say, I want to maintain a balance of whatever you want, and then move automatically that money to a 4% savings account. And if you get above a certain threshold, sweep that out to my JP Morgan money market account or whatever that might be. So now suddenly you have this tiered system where on autopilot, your money just works for you, right? And you have it in the right place at the right time. The same thing on lending. I don't think people, either people have a lot of money or they have a lot of debt. People don't realize sometimes how much they're spending on interest, right? The way to, in our opinion, to mitigate that is, just like you do it for your yield, you can do the same thing on your interest. Like if you have a line of credit that you can automate the movement between, then you can have a line of credit and a checking account. It automatically pulls down right when you need it, pays back when you don't. And then you can do that with another third line, an asset-based lender or a bank line of credit or wherever you want. So you automate your yield, minimize your interest, and that's usually worth quite a bit. Like juice is worth the squeeze for any business that's over $5 million.
Dude, yeah, look, and I think people should really understand this whole sweeps idea because it took me a long time to come around to it. I'm like, I have money in my bank. Like, where's it going? They're like, to a different bank that pays automatically. But you just say, hey, always keep $1 million in fresh cash, right? Like I need $1 million to cover daily expenses. But what am I doing with, I literally have an extra 5 million then because I keep about 5 million in treasuries. I have whatever, $6 million in my cash on hand account. And then like, okay, Sean, you don't need all that cash. Let's earn it quickly with whatever, 4%, 8%, whatever,
Yep.
right? And yeah, dude, it's smart. And if it goes automatically back and forth, it's all FDIC insured. It sounds pretty good. How come the big banks don't do this to me? They just don't have to?
Well, the answer before, they have record profits. The less facetious answer is, I think they don't, for whatever reason, they don't care at all the small mid-market, which is kind of crazy to me to think about you as a small mid-market, but they just are in the wholesale business. So if you're JP Morgan and you have a $1 trillion balance sheet or whatever their balance sheet is, like they honestly compete on regulation and kind of size. They are not competing, just like the telcos, like you mentioned, Matt, they're not competing on customer service and the best product to the customers. Like it's gotten so skewed that the big banks don't have to compete on products and service. Like, when was the last time you heard someone say that there's any difference in products and services from any of the banks, right? You name it, Bank of America, Chase, whoever it might be, right? They just don't have to compete on that. And so for the first time, we believe now that we can compete and win on things like customer service and product and making you money. And, there's other great companies out there that have started to do this, like Brex and Mercury and Ramp. But we believe if you really focus on the needs of this specific segment, you can actually build products that are for this segment. And that's, I think, the big difference.
Yeah. Well, the advantage of being at Citi is they might give you $60 trillion. So if you're not going to go
I heard that. They take it back, though. I'm pretty sure they got it back.
Yeah.
No, it makes a ton of sense. And also, we've seen that there can be really good venture outcomes in this space, right? Like, Ramp, $13 billion valuation, tackling the credit card first. And I think it does make a lot more sense to be like, no, we're going to tackle the bank account first. You guys eventually roll out a great credit card product or whatever else, but like actually nobody likes their bank. It's always a horrible experience. So actually making that seamless is awesome. I'm really excited for this AI layer thing rolling out. That's really what pushed me over the edge.
Yeah.
After this podcast ends, I have to go pull that manually. I'm not on HighBeam yet. So I'm really excited to like just get that every single day sent to me.
We're super excited about it, and we've been doing a lot of work here to basically what's happened is your financial data is scattered across the enterprise, as you know, right? You have your credit card data, you have your QuickBooks data, you have your Shopify sales data. It's all in like 10 different places. So first is get that together and clean that so you have a foundation in one place in real time. And that's a lot of the work we did. And then now, how do you get access to that data, both in a live Google Sheet, a 13-fill cash flow statement, but also now you can access that through LLMs or AI or other ways. So how do we go and launch now these kind of AI agents essentially to access that data that can also then move the money? And that's really the exciting part, because we can do that understanding this specific need. So the treasury thing we mentioned about like AI being able to move that money back and forth, but also doing basic scenario analysis. So with our AI launch that's coming out, we should be able to have you ask a question like, what would happen if my return rate on my top selling SKU spiked by 5%? What's the impact on cash? Now, we might have to ask a few more questions and kind of go through it, but we're very close to actually giving you a 95% accurate answer for those like quick, tell me this, because we have access to the accurate data. And that I think really becomes the game changer for like, could we give you a tool where you can literally log in and ask those questions that are top of mind, either for recall because you need that number right away, or you want to do a quick scenario analysis or whatever that might be. So you have to talk to your finance team.
It's like an AI FP&A person. Is that
exactly
like
right? So we're calling
I was
it. That's
going to
exactly
say,
right.
You eventually solve the biggest and most annoying operational problem that probably all of us have, which is inventory forecasting, right? And even the multi-billion-dollar brand. Exactly, scenario analysis, because it's fundamentally uncertain, right? You can do your best, but we have to draft up all these scenarios manually right now, and everyone does it in spreadsheets. Apple still does it in a spreadsheet. And so that's true, actually. Like they're still doing FP&A in a giant spreadsheet. So
well, now I get why David is working with you guys. This is pretty cool, man. Well, okay, I only have one question.
Please.
Okay, you guys dude, I moved to British Columbia from Burlington. So we are like cousins here, man.
Yes.
Like we were very close. Okay. When can I actually get this in Canada? Like I'm still a Canadian company. I bank with TD. I don't have when do I get the cool toys?
We've been asked that a lot as a Canadian. It hurts me to say no time soon. But if you have a U.S. entity, we're the bank for you. But it's just Canadian banks are even worse than U.S. banks when it comes to this stuff, which is hard to buy now.
Yeah. Oh no. You got you. Yeah, totally.
And so not quite yet. Although the AI layer, we can pull the data from the Canadian banks. So there might be a world in which you can get access to your AI analyst, actually not in the not so distant future, but not anytime soon is the unfortunate answer on the banking side.
All right.
Well, dude, this is a long-standing tradition of really smart Canadian operators making stuff for Americans. So from Shopify to Pillowcase to now HighBeam.
Yeah.
But Samir, before we end this, you said this is only available for certain size businesses. So who can benefit from this right now? Who is like the actual customer that can save money or make money using these tools?
So any business with over $1 million of sales, we're happy to talk to and onboard. And the reason we set that threshold is because we want to make sure that we provide the services out of the gate that makes them successful. So if you have over $1 million of sales and you're an omni-channel consumer brand, basically someone with physical goods that you're selling primarily online, but also on retail or wholesale, you're in a sweet spot. Anyone from $10 million in sales onwards, we would do a lot more with a free assessment and kind of a lot of the bells and whistles around trialing the AI, giving you a dedicated relationship management person, giving you a dedicated implementation person. And that's a large part of what we're trying to do here is take all of those janky manual spreadsheets that everyone has and make sure that we can use our data to automate those and then use those to go drive better business decisions. So that requires a lot of investment on our side, but we think that, anyone from $1 million onwards, we're happy to make that investment to try to make it happen. And that's kind of how we work with consumer brands in general.
Well, dude, I mean, that's everybody listening right now. So all 20,000 of you, David from, I guess he's the president of HighBeam now. So I guess you're the guy you get to hang out with every day. He told me that I'll be making over $300,000 a year for free from the treasury sweeps thing. Is that typical?
Well, you have a lot more cash than some have sitting in your 0% checking account, but it's not atypical to have hundreds of thousands of dollars of value. Like $300,000-$400,000 at a business your size is not atypical. That is completely accurate.
There's just free money. And
it's free money.
To be super clear how the free money is generated, it goes from a FDIC insured bank account to a different higher yield FDIC insured.
So let me just
account.
walk you through it exactly so there's no confusion, because it's a good point. People are like, wait a minute, why does this exist? So most people, you're running in a 0% checking account, your business day to day. And that's because the banks have decided that that's a good number that people should accept. There's no fundamental reason why it should be. So first of all, the money comes in from the day it hits the bank account, you're making 2.5%. Now, that will be swept to a high yield account, that's a savings account at say 4% every day automatically. And if you want to then sweep it again every day or every week to a money market account or a treasury account or whatever else account you want, you can set that up as well. So the way the FDIC insurance works is, that's kind of the sweep process. That makes sense? And so you're earning basically, instead of saying, oh, I'll let my money pile up in the 0% checking account until it's at 5 million. Then once a quarter, I'll look at it and say like, shoot, I should move this money out. Now you're moving it out every day. And the forecasting helps you be confident that you always have access to enough cash at enough points in time. So that's the sweep part. The FDIC insurance part is important to understand. So every account in the US has by default $250,000 of FDIC insurance. That is the federal government guarantees that your money up to $250,000, if the bank fails in the unlikely event, the federal government will make available to you the next day, right? So that is kind of the baseline protection that every bank account has. What we do is we're able to offer much higher than that through a process called intrabank sweeps. So this is what large customers do, which is they basically split your deposits into 250K tranches and overnight those to different banks and reconstitute it. So by doing the stacking, essentially all your money is FDIC insured, which is a big unlock to feel, safe, sleep well at night, to know that your entire cash balance is FDIC insured. So that is the mechanism where for larger companies, we've started at 3 million, but we've gone all the way up to 100 million, that you can go and make sure that you have FDIC insurance on your entire cash at all points in time. Did that answer your question, Sean?
Yeah. Look, and I'm gonna explain it back to all the other smooth brains out there in operators world. So what they're saying is, right now I'm just gonna say $5 million sitting in a 0% Chase bank account, and it's actually worse than 0% because they charge me fees every time I use it. So that bank account isn't staying flat; it's going down. And let's say in a typical 2-week period, I probably need access to $2 million, right? So I have $3 million extra in just bonus money that literally just sits in the bank account, makes me feel better. And what you guys are saying is, hey, look, we're going to take that $3 million and we're going to put that into a minimum of 2.5% annual, yield on that, up to 4. Maybe you can get 5.5 if you get something crazy. Money market, it's all insured or whatever. But then we're going to say it's $2.5 million. We're going to take that into 10 equal sums of $250,000 and spread that in 10 separate bank accounts that all have your name on it. You have access to, and you're still earning that yield. It's still insured, and it's either going to sit in your bank account or you can make some money for you. And there's 2 reasons why I signed up with HighBeam. 3. Number 1, I like David. I asked him to be on my board one time, so I really like him. I think he's a great operator. Number 2, I really am looking forward to this automated AI future. If AI is taking over coding, it makes a ton of sense for it to take over finance, right? Like, these are verifiable facts, so like it should be able to, bounce off and balance those things, right? And then number 3, I would love to make a free $300,000. So I'll let you guys know my experience with HighBeam in the next couple of weeks.
Amazing.
Right on. Well, guys, this was super great. It was nice to get the full unpack on everything.
And then last thing, plug on how people can access HighBeam. So we do have a special deal on highbeam.co/operators that'll be live to give people a 4-month access to the free AI features. So people can log in, try it out, try out the AI analyst, try out the AI treasury, try out the AI bookkeeping. And if it adds value, of course, we'd love to chat with them, but we'll make that available for free to all listeners as well.
You guys heard it here first. You want free AI, more AI in your business, potentially saving $300,000 or getting free money? Go to highbeam.co/operators. And then, Sib, on your side, how can I get 10% off my next laptop stand?
branchfurniture.com/operators, which is a link I'm going to create right after this session.
All right. So if you want awesome next generation banking or potentially some really cool, wooden furniture, Operators, the place to go, man. Thank you guys for being here.
Thanks so much, guys.
Appreciate it.
Well, you made it to the end. You are now a true friend of the Operators. Some other friends of the Operators: Northbeam, Fulfill, Postscript, Saras, Richpanel. 5 softwares, 5 sponsors. 5 softwares I actually use and pay for, and I was using and pay for before they started paying us for the podcast. Thank you for sponsoring the podcast, all 5 of you guys. Thank you for making it to the end. Thanks for being here. Talk to you later.